Good morning. I'm Donna Zarconi, President and CEO of the Economic Club of Chicago. I'm joined today by Charlie Evans, President and CEO of the Federal Reserve Bank of Chicago, who is also a board member of our club, and by our club chair, Debbie Cafaro, Chairman and CEO of Ventas Inc. Thank you both for being here today. I'd also like to welcome the members attending from the Economic Clubs of New York and DC, and we are delighted that you could join us. I'll start the program today with a brief introduction, and then Charlie will give prepared remarks, followed by Debbie asking questions that were submitted in advance by our members. And please note, this conversation is being recorded, and we plan to post the content for general access on our YouTube channel later today. So now it's my pleasure to formally introduce our moderator and our guest speaker. Our moderator is Debra Cafaro. She is the Chairman and CEO of Ventas Inc., and for more than 20 years under her leadership, this S&P 500 real estate investment trust has grown to own over or almost 1,300 senior housing and healthcare properties in North America and the UK. And Ventas also serves as a primary capital provider to many healthcare companies. And now on to our special guest speaker today, Charles Evans. He is the 9th President and CEO of the Federal Reserve Bank of Chicago. And in his role, he serves on the FOMC, which is the Federal Open Market Committee, as well as the Federal Reserve System's monetary policymaking body. Now, Charlie took on this role in 2007, so here you go again. He was actively involved during 2008, 2009 with a recession, when the Federal Reserve and Congress responded to stabilize and then stimulate the economy. So having learned firsthand how to manage that crisis, I know we are in good hands with you, Charlie, under your leadership, especially as we look to the future and what it holds after this COVID-19 pandemic. So thank you again for joining us. Now, Charlie, I'm going to turn it over to you.
Thank you. Thank you very much, Donna. Debbie, it's great to be here. Thank you for the invitation to speak. Let me say at the outset that these are my remarks only, and they don't represent any of those from my colleagues in the Federal Reserve System or the Federal Open Market Committee. I'll just open up with some brief remarks, and then we'll discuss things. So the pandemic and economic crises we face today are unprecedented. It is important to speak candidly about this national emergency and the almost unimaginable human losses we could experience from the pandemic in the United States and around the globe. Our hearts go out to those who have been stricken, and we can't express enough gratitude to healthcare providers, first responders, and others who are providing care to save lives and protect families and delivering essential services. They are truly heroes. On the economic front, we clearly are looking at very large losses in employment and national output. That is a simple fact. In response, enormous public policy efforts are underway to support households, businesses, and financial market functioning. Notably, the CARES Act provides for large additions to state unemployment insurance payments, a small business administration lending program that includes strong incentives for businesses to maintain employment, cash payments to the majority of U.S. households, and assistance to adversely impacted firms in leisure, travel, and other industries. In order to support the much needed flow of credit to households and businesses during these difficult times, the Federal Reserve has injected massive liquidity into the financial system, reinstituted many of the programs we used during the 2008 crisis, and added new programs in conjunction with support from the Treasury. I also want to acknowledge the substantial efforts by the private sector, from industrial efforts to transform auto manufacturing into the production of ventilators, to businesses keeping workers on the payrolls even when business activity has been shut down, and to debt forbearance by creditors. Many volunteers and organizations are stepping up to help keep our country safe during the pandemic. My own discussions with my staff with contacts throughout the 7th Federal Reserve District have described many heartwarming personal stories. There was the warehousing company that donated unleased space to FEMA, a commercial real estate firm we spoke with helping its tenants navigate SBA programs, and a child care provider taking in a neighbor's kids for free so that the neighbor could head to her essential medical job. All of these actions seek to convert the sudden and deep economic downturn that is currently underway into a relatively short-lived recession. With substantial financial support, households have the chance to meet expenses while sheltered at home. Many businesses should be able to meet their obligations, and the health situation allowing, the economy can begin to recover in the second half of 2020. But there are many caveats in this hopeful storyline, and many things must go right in order to minimize the economic pain. The medical community has clearly warned us all that the resumption of more normal levels of business and consumer activity will be dictated not by economics, but by the widespread containment of the virus and the public's confidence that they can safely return to more normal social and commercial activities. The economic downturn will be deep. There's no getting away from that. But the biggest risk that it will be deep and prolonged comes from the possibility of a more severe pandemic experience that delays an economic recovery in the second half of 2020 or even in the first half of 2021. This risk may be with us for a while. I have no expertise nor any role in designing public health policies, but we can be most assured of a sustained strong economic recovery when a vaccine is widely available so that workers, consumers, and businesses can safely and confidently go about their job of putting the economy back on its best footing. That could be sometime down the road. The United States has already committed trillions of dollars in welcome federal fiscal packages in relief support to the public, but even more action would be valuable. Funding a Manhattan Project-like joint effort of US and global experts to accelerate the development of a life-saving vaccine could have enormous returns. There are reports that Dr. Fauci is leading massive attempts to accelerate the development of a vaccine. And I've seen news reports that Bill Gates is supporting the establishment of 7 separate candidate vaccine initiatives with separate manufacturing production site developments. This recognizes that any single initiative is risky and its production will likely need to be customized to make it at scale. In the meantime, my conversations with healthcare leaders here in Chicago makes it clear that a national plan to distribute scarce personal protective equipment and ventilator resources to the regions that are in the most need is crucial for reducing the loss of life from the current surge. Furthermore, risk from potential second and third waves of coronavirus outbreaks must be reduced. A national plan that included greatly expanded testing along with contact tracing could help reduce the risk of future outbreaks altogether. This would clearly increase the odds of a quicker and stronger recovery. With our nation's best efforts, the virus will be contained soon and a vaccine will become available before too long. And if we've been successful in keeping businesses in place and keeping their relationships with employees, suppliers, and customers intact, then hopefully the US economy more quickly will get back up and running. But it is important to be candid about the future. Even under a best case scenario, the US and global economy will be less prosperous coming out of this crisis than we were going into it. As we hunker down and stay at home, we are all using valuable resources and savings that we had intended to use for other aspirations. Households, businesses, and our government have been on the front lines battling the economic consequences of these critical public safety measures. And it seems likely that additional resources will be required to navigate through the next several months and beyond. These resources are being very well spent. They are the key to maintaining economic relationships while we seek to contain the virus. Still, put simply, beyond the unimaginable human losses from this pandemic, no one should imagine they are financially immune from this crisis. We have a lot ahead of us, but it's important to remember that we entered this crisis with solid economic fundamentals. We have a good base to build on. Our future economic success may well require initiatives and national collaborations that we have rarely imagined, and not in recent times. Working together, households, communities, and businesses, in combination with strong government action, will get us through this crisis. So thank you for joining us.
Thank you so much, Charlie. We so sincerely appreciate your insightful remarks and your willingness to share them with our broader audience. Let's get started really with one of the comments that you made. Back in December, you talked about the economy and monetary policy both being in a good place, which clearly they were, and that it would take a material reassessment of the outlook to alter your stance of monetary policy. Certainly, we've had a huge material reassessment, and we'd love to hear from you how much a difference of a couple months make, and how the Fed has really responded so powerfully to this material change in outlook over the past month or so.
Sure. Yes, December seems like an eternity ago, and
Yes.
certainly, last year the Fed was looking at the state of the economy, and we were moving to a risk management positioning because we, thought that the fundamentals of the economy, while still good, were under challenge because of trade negotiations, trade barriers, uncertainty that businesses had about so many things, and the economy still continued to look good, but we were positioning for something else to happen. Well, now the pandemic crisis was not something that we were expecting. We were positioning for some type of adverse shock, but this is, once in a century, hopefully, type of shock. And the means of addressing what the country is going through right now are, they bear some similarities, but they are so vastly different than the financial crisis. And so we have certainly rolled out the useful financial programs that the Fed designed during the 2008 and 2009 financial crisis. We brought back the commercial paper funding facility, money market mutual funding facilities. We've introduced a few more things, but we got interest rates down to as low as they can go. Frankly, that wasn't the most important issue, because what we really need to do is provide relief for households, people who are out of work, businesses who have to stay at home for the next many weeks, 2-3 months. Hopefully, we can get back in that time. And so I think that the CARES Act that Congress passed, I think there's a tremendous amount of relief that is benefiting unemployed individuals. Households are going to receive a check, and Small Business Administration funding, I think, is supposed to be very helpful for small businesses. Still, there's so many small businesses that are going to be challenged to find their way to apply for those loans that are going to be smaller. They don't have a relationship with a bank that is the vehicle for getting access to that. And I think considerable thought about how to include those large number of entrepreneurs is going to be very important.
Yes. Well, let's talk a little bit about what you mentioned. And it's so beneficial that you were in your seat during the financial crisis. Can you tell us how what you learned in the crisis has helped you, even though the Fed has gone well beyond that in its actions to date?
Yeah, sure. I think one of the lessons that I learned during the crisis, and Ben Bernanke and the FOMC were out front in providing liquidity funding for financial markets to get them back up. It was quite a long slog, though, to get to a better recovery, and it took a long time, and we were challenged in meeting all of our objectives, including inflation. And so it just became apparent to me that we needed to be even bolder than the bold plans that Ben Bernanke put together, and keep at it until we absolutely saw us achieve our goals. And so I think that we're well on our way with the current legislation. With Jay Powell's leadership, we were able to quickly put in place the programs that had been previously designed. They had been on the shelf. We understood how to do it. And so those were helpful very quickly for financial markets that were trying to deal with a massive deleveraging and changing positions from things that just weren't making sense for them anymore. So that was good. Now we're in the period where we've got to figure out the design of these lending programs. It's not bread and butter monetary economics. It's not what central banks normally do. We generally buy safe assets where we can't take losses, government securities and the like. And now we're involved in actually providing funds, non-recourse loans that have some credit risk aspect to it. The Treasury provides first loss protection so that we can do that. And we just need to make sure that we get the funds distributed as best they can be done.
Yes, and it seems that the Fed has acted, as you said, very stronger and faster than it did in the financial crisis. Is that a recognition that this crisis is indeed bigger in many ways? And is it a reflection of what we learned in retrospect from the financial crisis?
So I think doing things in scale and being bigger and bolder is definitely something that we learned. I think that's definitely true. I think that a difference here is the magnitude of the downturn. I mean, 2008 was a massive downturn, but it was also mitigated in large part because of the financial programs. And so the unemployment rate rose to 10%, which was horrific. But I remember Ben Bernanke at one point saying that the financial shocks in 2008 were every bit as large as during the 1930s when the unemployment rate went up to 25%. And that didn't happen. So I think the Fed and the government programs were quite helpful, successful even during 2008. Current situation is really quite different. We're looking at trying to get the country, people in their homes, businesses, through the second quarter, while they're not able to go out because of the community spread of the virus and public safety challenges, and find our way, hopefully, to the third quarter when everybody can go back in a more guarded posture, probably, but can go back to work. We can go out, do commerce, shopping, and it's the hope that this can be temporary. It'll still have implications for the second half and next year, but if the unemployment rate goes up, and it's going to go up very high by some estimates, it's certainly going to be double digits, and it could go up to 20%. But then it could come down if we're successful with these programs and rebooting the economy in the third and second half of the economy. So that's really what's different. And so I think everybody understands that we need to get funds in households and businesses' hands so that they can use it, so they can make their payments,
Yes.
And all of that.
So let's talk a little bit about GDP and unemployment as you look forward to the second quarter. And let's assume that is the period of deepest impact from the pandemic. If a recession is just negative growth for 2 consecutive quarters, what are you thinking about how deep GDP could contract in the second quarter? I've seen estimates anywhere from annualized 20 to 50%. What are your expectations for that?
So I think the first quarter is going to be a negative growth rate. I think people had held out that maybe it would be positive to zero, but it looks like it's going to be pretty strongly negative. And then the second quarter is where the big decline is going to be. It is our convention to annualize this growth rate. And that convention kind of makes sense when you think that growth will continue for a 4-year or a multi-quarter period. We're hopeful that this is going to be a 1-quarter big decline followed by an increase. So that annualization doesn't make as much sense, frankly. But if you do it that way, the estimates that you threw out are like what I've seen as well, anywhere from down 15% to I've seen 40. Once you get up to a big number, it's just a big number. What we know is the second quarter is going to be really tough. The unemployment rate, we have already almost immediately seen initial claims for unemployment insurance skyrocket. I mean, the first week they rose 3.5 million.
Yes.
I mean, 600,000 used to be a very, very large number. 3.5 million, and then the next week they went up to 6.5 million. This is businesses saying everybody's got to go home. They've got to stay home, and they can collect unemployment insurance, which is very generous under the CARES Act. That's a very helpful, beneficial program that puts dollars in the hands of probably the most vulnerable who need. And if it's more generous than what they make, I think that's a good thing because they're going to need a little additional savings or resources for other things that are sort of beyond what we can imagine over a very brief period of time. So I think that's a very effective program. And that combined with the SBA and some other programs and payments to households, there is what sounds plausible is if we can get to the third quarter, July, and we get back to somewhat more normal commerce, then GDP will be higher, more people will be employed. What's really key is the relationships between businesses and employees. You can bring back your employees. You can find your employees, they come back to the job, and the job is still there. The business establishment is there. So by providing funds to maintain this relationship, it opens up the best chance of the most straightforward reboot of the economy in the third quarter.
Mm-hmm. Thank you. And so what you've described is an incredibly deep hole, the duration of which, on both GDP and unemployment, the duration of which we hope will be a quarter, but could be more prolonged, as you discussed. Let's talk specifically about both the fiscal stimulus and, again, go back to some of the Fed actions that are designed to mitigate the losses that businesses and households are going to suffer, as well as the stabilizing of the capital markets. So you've mentioned the CARE Act. It's a $2+ trillion act designed to help households and businesses get through this difficult time. Let's talk about the SBA program, for example. Can you explain what it means for small businesses? We already have $350 billion allocated. Can you talk, the program was set up on Friday. Can you talk a little bit about how you expect businesses to access this program, what it'll do for them, and where we can take that program from here?
So the type of lending activity will take place through a bank, a business establishment will go to their bank. Their bank could be a preferred lender through the SBA program or just a lender, but they've got a relationship with the SBA. And the terms of the loan are such that the business can take out what I believe is 2.5 months of payroll, as a loan, and perhaps a little bit more than that. There's some percentages above 100% that, depending on your rating, allow you to do that. If you maintain your workers during that time period, it becomes a grant and it's forgiven. And so it ends up being something that, keeps the businesses in place. The bank originates this, they earn a fee for the origination, they get paid through the SBA because it's SBA guaranteed. It's $350 billion, which sounds like a lot of money to most people, but in fact, it probably is not nearly as much as businesses need.
Yes.
There's current talk about increasing the magnitude of that. I've seen reports of $250 billion of additional funding being done. I think many of these programs are going to be run through the banks. After all, what the Federal Reserve does is central banking, and we provide overall general liquidity that financial markets are able to use, but we don't deliver funds to individual entities like businesses and households. And so that's the purpose of commercial banking. And so the banks end up being the conduit through, in this case, the SBA, in other cases through perhaps the Main Street lending facility that the Fed is currently looking at and trying to figure out how to design it to support larger entities than the smallest businesses. But ultimately, we're going to be counting on the banks to be originating these under the terms of these programs. And so it's very important that the banks have an appetite for this. It has to be sufficiently good activity for them. But it is also the case that there is a national need. I mean, the president has declared a national emergency, and we really need to get these funds out to businesses, entrepreneurs, households, and vulnerable populations so that they can make it through to when things get better. Then we are going to be better positioned to have lower unemployment rates like we enjoyed in last year and that type of thing.
And the Fed is going to provide an additional assist. You mentioned this is not your grandfather's monetary policy or traditional activities. You're going to
Correct.
provide an assist to those banks by allowing them to securitize those loans, and you'll take them onto your balance sheet?
So there has been an announcement that the Federal Reserve is going to do that. That is through the Board of Governors, and I believe they are designing that. But my expectation is that that will provide welcome relief for the bank's balance sheet, so that for a variety of regulatory reasons, if they just sort of keep building up certain types of loans, then they have to have capital behind that. And if we can somehow take that off so that they can originate more, that's very important and very useful for getting the economy going in the third quarter again. Yes.
And then moving away from the CARES Act a little bit and talking about what the Fed has done with some of these other programs, your balance sheet has now gone from 4 trillion to 6 trillion in a short period of time since February. You've injected massive liquidity. Can you just touch on some of the programs that you have done to stabilize markets and add liquidity, whether it's the money market backstop or some of the other interesting programs that you have rolled out to get us through this tough patch?
Sure. So one of the things that we did right away during the course of lowering interest rates to the lowest level, the effective lower bound, was that we were also providing additional reserves for financial markets. The issue was that there wasn't a lot of liquidity in many markets, a lot of investments that make sense during normal times to arbitrage interest rates that in principle should be closely related to each other, involve highly illiquid assets. But if you're able to hold those assets for the period of time, the fact that they're illiquid is sort of irrelevant. But if all of a sudden things turn against you and you have to unload them, their illiquidity becomes an enormous problem.
Yes.
And so we got to the point where just short-term money market rates weren't reflective of what we thought true economic financial underlying conditions ought to be, given the amount of accommodation. And so we did repo operations. We basically tried to get reserves back up. We tried to increase our balance sheet back to what the markets really seemed to need during this period of stress. We had held out the hope that we could have gone back to a more normal size of the balance sheet, but during a period of stress, that wasn't feasible or a good policy. So that was early on. Then we quickly recognized that the large banks have important relationships with corporations, money market funds, and the commercial paper market was challenged, and it became important to help understand how the bank could maintain its ability to originate intermediate credit so that we could keep going and not run afoul of certain regulatory ratios that would limit their ability to do that. It was also the case that a lot of entities like money market mutual funds were seeing big redemptions, and so they wanted their money back in order to meet the redemptions, and so banks have had an awful lot of lines of credit drawn. By putting forward our commercial paper funding facility, we've been able to, we will be able, by announcing that we're going to do that, I think that provided relief. It's still, I think, a week away from being actually trading. It's also the case the Boston Fed stood up a slightly updated version of a program that they had back in 2008, the Money Market Mutual Fund Liquidity Facility, and this also offers money market funds and banks relief so that that commercial paper can be put non-recourse against the Fed, and it should be fine. They pay a fee, for that. So this is some of the programs early on.
Yes, two interesting new ones, and then we'll move on. But two interesting new programs that you came out with was intervention in the corporate bond market to help that market function. And also globally, we are the reserve currency. And so, but we're only 15% of the world's GDP. And you did something interesting there as well. Why did you do those two things? And could you just briefly explain to our viewers what those actions do and why you did them?
Sure. So I think the, we've announced that we are putting together a primary market corporate credit facility. And so this is a facility where, institutions that issue corporate debt of a maturity up to 4 years, they could issue that, they could receive the funding from investors, and then they know that also that the Fed can step up and also supply that funding in a particular fashion, and they pay us a fee for doing that. That introduces a little bit of credit risk. These have to be highly investment grade corporations, and but still there is some credit risk, and so the Treasury provides us a first loss protection for us to stand up that special purpose vehicle to do that. The fact that the Fed stands ready to conduct that activity adds confidence as corporations go out and seek to issue normal corporate credits from private investors. And so I think the fact that we have not yet stood this facility up, because we're working on the terms of it, it's still a few weeks away, I think, but I think that that's helped provide support for that.
Well,
and the other one is
the announcement itself did reopen the huge investment grade bond market. So it's been effective without even starting.
Right. And it's important to follow through, of course, on that. I think one thing that was learned back in the 2008 crisis was we talked quite a lot about the term asset-backed securities loan facility when the asset-backed securities market was really not functioning very well. And Bernanke and Tim Geithner and Bill Dudley put that together in 2009, and it really took a long time to kind of roll that out. And by the time it really got up to scale, we really didn't end up doing that much lending relative to the assurance and support that the announcement effect had. If things had gone worse, we would have gotten a lot on that. On the international program that you're talking about, which is I'm forgetting the acronym is FEMA, F-I-M-A, and it's basically we have swap arrangements with very large major foreign central banks like the ECB, the Bank of Japan, where they can gain access to dollars, and we will accept their foreign currency. We just, at whatever the exchange rate is, we swap the amount of foreign currency for dollars, and then they can conduct their credit intermediation for for foreign investors that way. So it's very important, and there's no loss to us because when it ends up being closed, we get back exactly the amount of dollars that we gave to them, and so that's fine. We expanded that to a larger number of central banks than we had in place before this crisis, but we went back to the larger number that we extended it to in 2008 and 2009. As you might imagine, there's an intense desire for dollars around the world, and central banks and investors that didn't, non-government institutions that didn't have access to the swap lines were trying to get dollars. And so it is the case that many of them have accounts at the New York Fed where they have treasuries. And so what we did was we opened up a repo facility so they could take their treasuries, which are already in New York, on those accounts, and repo them so that they can get the dollars that they ultimately want, totally safe. And there's a small fee for doing that. And that's a very clever type of operation where we don't have to actually open up an official swap line, which is much more involved. And so that was a new innovation relative to the 2008 crisis.
Right. Well, let's kind of, so you've done all these things. Is it possible that depending on where things go, you would engage in even more activities, including things like negative rates or intervening in the equity markets or some other experiments, if need be, to assist the country to go through this significant downturn?
So that's a great question. It sort of harkens back to the 2008 crisis and then the slow recovery, and then we continued to do more because we weren't able to meet our inflation objectives because unemployment was very stubborn and high at 9% back in the summer of 2011, even when things should have been going so much more. And so we did a lot of asset purchases. The question would be, should we have had negative interest rates? Should we have done even more asset purchases? Back at that time, the 10-year Treasury rate was 2.5%, 3%. And so trying to get it down so that corporate borrowing rates and mortgages would be lower was helpful. 10-year Treasury, when I looked just a little bit ago, was like 72 basis points.
Right.
I don't think the long end of the Treasury curve is what the real problem is. I think at the
Right.
moment, we're really, and it's still early, this is really all about, there is a very sharp, sudden stop. It is extremely costly.
Yes.
And if we can get as many business employment relationships held together into the second half of this year and households able to make enough payments and find a way forward, then we can start seeing what does the future look like? What is our growth path? I said in the speech, I mean, we have to take into account that these are resources that are being used up. If you had been saving for your children's college education, but you've been using those funds, if you had been putting aside funds for a rainy day, this is a torrential storm.
Yes.
And all of that. And then after we get through that, those funds aren't going to be available, not in the quantity that they were before. And that's going to be true for everybody to some extent. So the question is, what does it look like going forward? And what is credit intermediation, and how strongly can we grow? I think that the Congress and the president and the Federal Reserve has acted in a partnership with them. We're putting a lot of resources in places where I think that it's helpful. And we ought to know a lot more in the third quarter, certainly the second half of this year. And so much of it really does depend on the public health success.
Yes. So let's bring that back and talk about something positive like a recovery. And clearly the bull case is that it is a third quarter, second half activity. But let's talk about the different aspects of how it could manifest. People use kind of an alphabet soup of a V-shaped recovery, an L, a U. Maybe you could explain what those mean and what the base case expectations are for that. And then also how much more, we've talked about the CARES Act maybe being a down payment on what we need. How would the different recovery time periods and shapes affect what you need to do, what monetary and fiscal policy would need to do going forward? And what's the base case expectation as we think about a more positive future?
Right. So what does the recovery look like? First and foremost, it's going to depend on the successful prosecution of public health safety,
Yes.
getting us through the current large increase in COVID-19 cases.
Yes.
and all of that. We need to get to a point where people can safely open up their storefronts, open up their businesses, send people back to the factories, go shopping, and all of that. If there's a vaccine, wow, that's fantastic. But it looks like that's a year, 18 months in the future. Maybe somebody will have a tremendous breakthrough. Maybe we will get the state of testing to a point where it is so widespread that we can actually track new outbreaks so that they don't end up leading to a second wave, which is economically a big headwind. And so if we can do enough in order to knock down any future waves while still doing commerce, I think that's the closest that we could hope for something that V is probably pretty strong. That would be sort of starting up in the third quarter and just going back to where we were. But if we move very strongly in that position, that would be good. I think if we're still struggling with second waves of the virus and people aren't feeling safe, so they're not going out, I think that would be quite a challenge. I think another issue that is going to rear its head at some point is there's an awful lot of debt that had been taken on, normal debt, your mortgage payment and things like that. Storefronts where there's a lease, commercial real estate buildings, and you've got creditors that have always been expecting payments. Now the question is, what is the payment stream going to look like? And if the expectation is that it's exactly what you were expecting before and everybody else has to make the payment, then that's going to lead to an enormous debt overhang and many bankruptcies and a lot of financial distress, and all of those things are impediments that would slow down the recovery. A successful navigation of how those debts are resolved, losses are sort of shared. I think there's so the fact that the CARES Act is so large, the fact that there's considering doing more means it's more likely that this is taken on the government's balance sheet. So many of these losses, and then it's national, and then we figure out how to share those losses as we would, because it's a nation, as opposed to just a collection of individuals who, left to their own devices, would sort of fight over, who has to bear all the losses, and that would end up being extraordinarily costly. So I think attitudes like that are going to be very important. But I think the public health safety is going to be first and foremost the determinant of when it's going to be safe to go back to work, when people are going to be comfortable, when they're going to be most productive. Because if people are back at work, but they're not really feeling comfortable, it's going to be hard to be your most productive, I would say.
Well, we are captive to the pandemic and maybe the upside surprise of some of the scientific and medical activities that everyone is racing forward on, and that would be great. But when you think about the losses, you talked about shared losses. Do you have an estimate of how much our country is going to have to absorb, businesses, households, and the government, in terms of losses and additional incremental debt as a result of this pandemic?
I do not have an estimate of that. I mean, I think that, the legislation that's being undertaken, you just add up that's part of, what this is in a more ideal situation where households receive enough in the form of relief payments so that they don't have to spend their savings so much, then it would be the magnitude of the relief payments that really would sort of quantify what the losses are. After all, if households are able to make their payments, if they're able to make their rent, they're able to make their mortgage payments, then the creditors would end up doing as well as they were going to. Some people are going to not survive this, businesses and things like that. So there's those bankruptcies. But to the extent that more is provided so that everyone makes it through to the third quarter and beyond, that would tend to reduce the number of economic impediments, I think, to future growth.
Right. And one more question about the shape of the recovery. Even in December, you noted that there were some soft patches in a otherwise really good economy, from trade and manufacturing and business investment. But the consumer was powering the economy forward. And so if the consumer is either doesn't have any resources coming out of this, has used up its savings, or has had to take on a lot of other debt, I mean, how does that affect the go forward post-pandemic of the economic outlook?
That's an important question, because it definitely has been the case for quite some time prior to the pandemic that the consumer was the source of strength. One would have guessed that it would be business spending and business investment that would have stepped up and been much stronger, especially after corporate tax reform and tax cuts. But then there was also the trade negotiations and tariffs and all of that got in the way, and the international economy slowed down also in part due to that. So there was always a hope that there'd be a resolution to the trade negotiations so that that uncertainty would be resolved, so that businesses knew how to invest confidently for their future, and then that could help further sustain the consumer through strong, lengthy employment relationships. But the idea that the consumer alone can drive the economy without businesses also being an important driver for growth, that was always a little nerve-wracking as to how long that could take place. Now, with the pandemic, and as you come out of this, that's why it's so important that households, if you're thinking of them as a source of strength, well, they'd better be strong coming out of it. It's going to be a different economy. I think businesses are going to be having to think about how they want to expand, what markets they want. Obviously, we're using a lot of digital technology. I don't think we're going to just all of a sudden decide to stay and work at home because, as useful as that can be for a short period of time. I thought that one of the true benefits of Silicon Valley and other startup entities was you got a lot of smart, engaged people in a room. They were crammed together and they worked really well and came up with brilliant ideas, and you had more diverse thinking around the table. And it's harder to do that in these settings. We're learning to navigate it, but how do businesses think about that? I mean, you must be thinking about it in your own investments once we get to that point.
Very much so. And these comments will give us great context to make better decisions going forward. Let me ask you this. The Fed is a real treasure, and we appreciate everything that the Fed is doing as business people. And your independence is something that is highly prized and enables you to do the right things in all types of environments. Can you give us any insight into, I know you're very data driven in what you do, but as you've looked from the end of February into this flurry of activity in mid-March and into April, how do you make decisions with the incredible dispersion of possible outcomes that you're facing and the speed at which you're having to act? Can you give us any insight and color into that decision-making process?
Sure. I mean, I would start off by saying that, our independence is very important. And by that, I mean, we get together and we think about what the right settings for monetary policy are in order to support the economy so that it can achieve maximum employment and price stability.
Yes.
For much of our history, we've thought that the price stability issue was the really hard issue. The increase in inflation in the 70s obviously was something that you never wanted to repeat. So much of the commentary about the Fed has usually been, are they going to keep inflation under control? But it has been the case and always will that the state of monetary policy is fundamental for helping the economy during a downturn, and during a horrific downturn, then it continues to be important. Now, what's unusual about the current situation, I mean, in the current situation, I used the term in my prepared remarks, which in the past might have been a little controversial, which is, this downturn looks like it's going to be a short-lived recession. Hopefully it's short-lived. The emphasis should have been on short-lived. Historically, people in the Fed wouldn't mention recession until it was absolutely officially determined. But I mean, this is such a severe downturn. The unemployment rate is going to go up to double digits. It was just very clear that a lot of relief, economic relief and stimulus was called for. And so I think under Jay Powell's leadership, we swung into action very quickly. I think with the Treasury Secretary Mnuchin, there's a good partnership. And I think those on Capitol Hill and the president were supportive of all of this, that it became very clear that a lot of additional help was necessary. And the Fed has, it's probably been very useful that during the 2008 financial crisis, we had already gone through introducing these programs, which conceptually were a little challenging for us. We're not supposed to undertake credit risk. We're not supposed to take losses. And so these special purpose vehicles, the TALF and all of that, the Treasury gave us first loss protection, and we got to the point where we were comfortable with that. So now, as we contemplate a Main Street lending program, and again, the design and details are still to be worked out for maximum effectiveness, but our willingness to even think about that, I think it was a good investment back in 2008. And so thinking about those programs, putting the resources in the hands of people who needed it most, that's not usually what the central bank does. Yes. But because we're uniquely situated with the Treasury under the right circumstances, we can more effectively support maximum employment. And I just think that was an obvious thing that we needed to do.
Well, thank you, Charlie.
Thank you.
Thank you, Debbie, for this very insightful and informative conversation. Charlie, we would love to have you back as we get further along in this process. But we do appreciate you both taking the time to be with us today.
Thank you.
And also really appreciate your leadership in the Economic Club of Chicago and in the greater Chicago community. And as I mentioned earlier, we recorded this program and it will be uploaded to our YouTube channel later today. So please feel free to share the video with your network of colleagues, friends, and family. This is very informative. To our members, we always are interested in your feedback, and we will be sending a survey on this program to seek your input. And as Charlie mentioned, we all can help to mitigate this crisis. So please stay safe, stay home, and help out our healthcare professionals, first responders, and all those who are working on the front lines on our behalf on this crisis. So thank you again.
And we wish all of you and those you love good health. Stay safe. Thank you very much.
Thanks.